Did you know that between 2008 and 2012 alone, over 465 banks failed in the United States? That's right. The very institutions we entrust with our hard-earned money, the vaults we believe to be impregnable, have shown themselves to be far from infallible. Many of us have been brought up with the belief that banks are the safest place to keep our hard-earned money. But is that really the case? Let's take a moment to examine this widely held belief. Banks are indeed a safe place to store money, but they are not the only option, nor are they necessarily the best. In fact, keeping all your money in the bank could be putting your wealth at risk. How, you may ask? Consider this. Inflation. The value of money decreases over time due to inflation, so the money you've tucked away in your savings account today may not have the same purchasing power in 5 or 10 years. Now, let's introduce a concept: assets. Assets can be anything from stocks and bonds to real estate and precious metals. They can even be intangible items like intellectual property or digital assets such as cryptocurrencies. The beauty of assets is they have the potential to appreciate in value over time, acting as a hedge against inflation. In other words, rather than diminishing in value like cash sitting in a bank, assets can grow and provide better returns. But are assets really safer than banks? Well, there's a reason why the wealthy invest their money in assets rather than keeping it all in the bank. Assets, when chosen wisely, can be both a safer and more profitable way to store wealth. But of course, like all things in life, it requires knowledge, strategy, and sometimes a bit of risk. So, let's embark on a journey to uncover the world of assets. We'll delve into 7 different types of assets that you may want to consider as alternatives to keeping your money in the bank. From the tangible to the digital, each of these assets offers unique benefits and opportunities for growth. Are you ready to discover these 7 assets that can offer you safety and better returns than your money sitting in the bank? First on the list, real estate, a tangible asset that often appreciates over time. Let's delve into the world of property. Unlike cash, real estate is an asset you can touch, feel, and even live in. It's not just a number on a screen or a piece of paper in a safety deposit box. It's a physical, tangible investment that, more often than not, appreciates over time. Now let's talk about the benefits of owning real estate. One of the primary attractions is the potential for rental income. Imagine owning a piece of land or a building, and instead of it just sitting there, it's generating a steady stream of income for you. That's what we mean when we talk about rental income. It's like having a dedicated workforce that's out there, working tirelessly to make money for you. But that's not all. Real estate often appreciates in value over time. This means that the property you buy today could be worth significantly more in the future. That's the beauty of appreciation. It's the gift that keeps on giving. And let's not forget the tax benefits. Real estate investment comes with a myriad of tax advantages. From deductions on mortgage interest, property taxes, and operating expenses to depreciation, these benefits can help to reduce your taxable income and increase your overall returns. Moreover, real estate investments are often seen as a stable form of investment. While the market may fluctuate, the demand for property tends to remain relatively consistent. This stability can provide a sense of security and peace of mind that's hard to find with other types of investments. So, let's recap. Real estate offers the potential for rental income, appreciation, tax benefits, and stability. It's a tangible asset that you can see, touch, and even benefit from directly. So, would you rather have your money sitting in the bank or invested in real estate? Next up are stocks. Stocks are a great way to own a piece of a company. Picture this. You buy a slice of a successful corporation, and as it grows, so does your slice. This is the basic idea behind investing in stocks. It's about tapping into the potential for high returns that the stock market offers. When we talk about returns from stocks, we're looking at 2 main avenues. First, dividends. These are a portion of a company's profits distributed to shareholders. They're like a thank you note from the company for your investment. Some companies offer attractive dividends that can be a steady source of income. The second avenue is capital gains. This is when you sell a stock at a higher price than you bought it. Let's say you bought a stock at $10 and sold it at $15. That's a $5 capital gain right there. So, with stocks, not only can you earn from the company's profits, but you can also make money as the stock's price increases. Now, it's essential to mention that the stock market comes with its share of risks, and that's where diversification comes in. Think of it as not putting all your eggs in one basket. By investing in a variety of stocks across different sectors, you can spread the risk. If one stock doesn't perform well, others might make up for it. It's also crucial to adopt a long-term perspective when investing in stocks. The market might fluctuate in the short term, but historically, it has shown an upward trend over the long haul. Patience, my friends, can indeed be a virtue here. So the question arises, is your money sitting idle in a bank, or is it out there in the market, potentially growing with every passing second? Investing in stocks can be a powerful way to grow your wealth. Is your money working for you in the bank? Third on our list, bonds, a safer bet in the world of investing. Think of bonds as an IOU, where you're loaning your money to an entity, like a company or government. In return, they promise to pay you interest at regular intervals and give back your initial investment at a predetermined date, known as the bond's maturity. The safety of bonds lies in this promise. Even if the stock market crashes, bondholders still receive their regular interest payments and their principal upon maturity. And while it's true that bonds can fluctuate in price, they're generally considered less volatile than stocks. Here's the magic of bonds. They provide a predictable income stream. Every 6 months or so, you'll find interest payments in your account, like clockwork. And when the bond matures, you get your original investment back. Bonds can provide a steady income stream. Can your bank account do that? The fourth asset to consider, mutual funds, a diversification tool for your investments. Let's dive into the world of mutual funds. They are essentially a pool of funds collected from numerous investors, which are then invested in a diversified portfolio. This portfolio could include a mix of stocks, bonds, or other securities, and is managed by professional fund managers. Think of it like a shared investment pot where everyone contributes and reaps benefits proportionate to their investment. Here's the beauty of mutual funds. They allow individual investors access to a diversified portfolio that they may not be able to afford or manage on their own. Now, let's talk about the benefits of diversification. Have you heard of the saying, "Don't put all your eggs in one basket"? That's essentially what diversification is all about. It's a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique is that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Mutual funds take the guesswork out of deciding what stocks or bonds to buy. Instead of you having to research and decide which company's stock or bond to invest in, a professional fund manager makes those decisions on your behalf. These fund managers have the experience and resources to make informed decisions, which in turn can lead to potential higher returns. Now, consider this. Mutual funds can provide exposure to a wide range of stocks or bonds. This means that even if one or two companies in the portfolio don't perform well, it's likely that other companies in the portfolio will. This spreads out the risk and can help limit any potential losses. Mutual funds can provide a diversified investment portfolio. Is your money diversified in the bank? Fifth on our list, gold and other precious metals, a hedge against inflation. Now, let's delve into a treasure trove of financial security that has been around for centuries. Gold, silver, platinum, and palladium, among others, are the precious metals that have held their value throughout human history. They are tangible assets, real and rare, and they have intrinsic value that paper money or digital figures simply can't match. Historically, gold has been a universal symbol of wealth and power. From the golden sarcophagi of ancient Egyptian pharaohs to the gold rush in the mid-19th century, the allure of this precious metal has been undeniable. It's not just about the glint and glamour, though. Gold has proven itself to be a reliable store of value, especially during times of economic uncertainty. But gold isn't the only precious metal worth considering. Silver, often referred to as poor man's gold, has industrial applications that give it value beyond just its rarity. Platinum, rarer than both gold and silver, is highly sought after for its use in jewelry and industry. Palladium, the high-flying precious metal, has soared in value due to its utility in reducing harmful car emissions. So, how do these precious metals act as a hedge against inflation and currency fluctuations? Well, when the value of money decreases due to inflation, the relative purchasing power of gold tends to remain stable. In other words, even if the dollar or euro weakens, an ounce of gold will still be an ounce of gold. This makes precious metals a safe haven in stormy economic climates. Moreover, unlike a bank account, gold and other precious metals are not subject to the same risks associated with financial institutions. They can't be hacked, they don't default, and they won't disappear if a bank goes under. In conclusion, by diversifying your portfolio and investing in precious metals, you're not just purchasing a shiny object, you're buying a peace of mind, a sort of insurance policy against the unpredictable future. Gold and other precious metals can protect your wealth. Can your bank account offer the same protection? The sixth asset to consider: cryptocurrencies, the digital asset of the future. Cryptocurrencies, a term that was once a mere whisper among tech enthusiasts, has now become a roar in the world of finance. With the advent of Bitcoin in 2009, we saw the birth of a new asset class that has been steadily gaining traction, capturing the attention of investors worldwide. Imagine an asset that exists purely in a digital realm, free from the confines of traditional banking systems. Cryptocurrencies offer this vision. They are decentralized, meaning they are not governed by a central authority like a bank or government, and their value is determined by the market supply and demand. This new asset class's allure lies in its potential for high returns. Bitcoin, the pioneer of cryptocurrencies, is a prime example. From being worth just a few cents in its early days to reaching staggering highs of over $60,000, the potential for significant returns is undeniable. Cryptocurrencies have also democratized investing. Regardless of where you are in the world, if you have an internet connection, you can become a cryptocurrency investor. This accessibility is a game changer, opening up opportunities for wealth creation to a much broader population. However, with great potential comes great risk. Cryptocurrencies are notoriously volatile. Their value can swing wildly in a matter of hours, leading to significant gains or losses. They are also susceptible to regulatory changes, technological issues, and market manipulation. In addition, the anonymity that cryptocurrencies offer can be a double-edged sword. While it provides privacy, it also makes the market a breeding ground for illicit activities, adding another layer of risk. The world of cryptocurrencies is not for the faint-hearted. It requires a good understanding of the technology behind it and a high tolerance for risk. But for those who are willing to navigate its tumultuous waters, the potential rewards can be vast. Cryptocurrencies can offer high returns. Can your bank account match that? Finally, art and collectibles, unique assets that can appreciate over time. These aren't just your typical investments, they're a blend of passion and profit. You see, art and collectibles such as vintage cars, antique furniture, or even comic books can significantly increase in value over the years. But what sets these assets apart is the enjoyment they bring. You can marvel at a painting hanging on your wall, or take a Sunday drive in your vintage car. They're investments you can touch, feel, and enjoy while they potentially grow in value. Consider, for instance, the world of fine art. A piece purchased for a few $1,000s could eventually fetch millions at an auction. And it's not just about the money, it's about owning a piece of history, a work of beauty, something truly unique. Art and collectibles can offer both financial and personal rewards. Can your bank account do that? So where's your money safest? Let's take a moment to recap. We've journeyed through 7 assets that could be safer and better than keeping your cash in the bank, each with its own unique benefits and risks. We started with real estate, a tangible asset that can provide a steady income stream. Then we explored stocks, a gateway to owning a piece of a company and potentially reaping rewards from its success. Bonds offered us a safer bet, with regular interest payments. Mutual funds presented a way to diversify, spreading your investments across many stocks or bonds. We looked at gold and other precious metals, which have historically held value even during tough economic times. Cryptocurrencies provided an exciting, albeit volatile, new frontier for digital assets. And finally, art and collectibles offered an opportunity to combine passion with investment. Remember the importance of diversification and investing wisely. Never put all your eggs in one basket. Remember, your money can work harder for you than it ever could in the bank. So, where will you put your money?